If you hold cryptocurrency in Australia and you have not yet fully understood what the 2026 federal budget means for your tax position, this video is the most important one you will watch this year. On Budget Night, 12th May 2026, the Australian government announced the most significant change to capital gains tax in over 25 years. The 50% CGT discount, the mechanism that has protected long-term crypto investors for more than 2 decades, is being replaced. A new 30% minimum tax on capital gains is being introduced, and every Australian who holds crypto assets needs to understand what this means for their position before July 1, 2027. In this masterclass, I am going to take you through everything. The current rules that apply right now in the 2025 to 26 financial year. The exact changes the budget announced and how they work. What this means specifically for Bitcoin holders, Ethereum investors, DeFi participants, and NFT traders. The timing strategy question every investor is asking right now. How to keep records correctly and use tools to manage the complexity. The most common mistakes that trigger ATO audits and how to avoid them. And a clear, practical action plan you can implement today. This is a comprehensive education. By the end of this video, you will have a complete understanding of the Australian crypto tax landscape in 2026 and exactly what you need to do about it. Let's begin. Before we address the budget changes, we need to establish the foundation, because the new rules build directly on the existing framework. If you understand the current system thoroughly, the changes will make complete sense. The ATO's position on cryptocurrency has been consistent since 2014. Cryptocurrency is treated as a capital gains tax asset, not as currency, not as foreign exchange, not as a commodity for general tax purposes. This single classification drives everything else. As a CGT asset, cryptocurrency is subject to the same fundamental rules that apply to shares, investment property, and other capital assets. Every time you dispose of a crypto asset, meaning every time ownership effectively changes or value is extracted, a CGT event occurs, and a tax liability may arise. What constitutes a taxable event? Well, pay close attention here because this is where most investors misunderstand their obligations. A taxable CGT event occurs when you sell cryptocurrency for Australian dollars. This is the obvious one most people understand. Trade one cryptocurrency for another. If you swap Bitcoin for Ethereum, that is a disposal of Bitcoin and an acquisition of Ethereum. A CGT event occurs on the Bitcoin at the moment of the swap. The proceeds are the Australian dollar market value of the Ethereum you received. Use cryptocurrency to purchase goods or services. If you use Bitcoin to pay for a product, that is a disposal of Bitcoin at its Australian dollar value at the time of payment. Gift cryptocurrency to another person. A disposal at market value occurs even though no Australian dollars change hands. Move cryptocurrency into certain DeFi protocols. Depositing assets into a liquidity pool or certain staking arrangements may constitute a disposal depending on the structure. What does not constitute a taxable event in isolation includes transferring cryptocurrency between your own wallets, provided both wallets belong to you and there is no change of beneficial ownership. Calculating your capital. Gain or loss is straightforward in principle. Your capital gain equals your proceeds minus your cost base. Your proceeds are the Australian dollar value of what you received at the time of disposal, whether that is cash, other cryptocurrency, or goods and services. Your cost base is what you originally paid to acquire the asset, including the purchase price and any incidental acquisition costs such as exchange fees, brokerage fees, and gas fees. These fees are frequently overlooked, and their inclusion in the cost base directly reduces your taxable gain. On a large number of transactions, this can be materially significant. Let me illustrate. You purchase one Bitcoin for 15,000 Australian dollars, including fees. 2 years later, you sell it for $45,000. Your capital gain is $30,000. If you paid $500 in fees to acquire it, your cost base is $15,500 and your gain is $29,500. The fees matter. The 50% CGT discount under the current rules, which apply to the 2025 to 26 financial year, if you hold a cryptocurrency asset for more than 12 months before disposing of it, you are entitled to the 50% CGT discount as an individual taxpayer. This means only half of your capital gain is included in your assessable income. The other half is entirely disregarded. On our example of a $29,500 gain, with the 50% discount applied, only $14,750 is added to your taxable income. The remainder is tax-free. This discount has been the cornerstone of long-term crypto investment strategy in Australia since 2014. Understanding that it is changing and exactly how it is changing is critical for every investor in this room. Capital losses occur when your proceeds are less than your cost base, meaning you disposed of an asset for less than you paid for it. Capital losses can be used to offset capital gains in the same financial year. If your losses exceed your gains in a given year, the excess is carried forward indefinitely to offset future capital gains. Capital losses cannot be used to offset ordinary income such as salary or wages. This distinction is important. An investor who makes a capital loss has a less flexible tax position than a person carrying on a trading business, whose revenue losses can offset all income. We will return to this point in the investor versus trader context later. Not all crypto tax events are capital gains events. There is a separate and important category of crypto tax treatment that falls under ordinary income, and misunderstanding this category is one of the most common errors Australian crypto investors make. Staking rewards. When you participate in proof of stake staking and receive rewards, those rewards are treated as ordinary income at the time of receipt. The amount of income is the Australian dollar market value of the tokens on the day they are received. This income is assessed in the financial year it is received, regardless of whether you sell the tokens. This creates two separate tax events. First, income tax at the time of receipt, calculated on the market value when received. Second, a capital gains event when you eventually dispose of those tokens, calculated from a cost base equal to the value you declared as income. You are not taxed twice on the same dollars. But there are two separate events with two separate calculations. Let's look at a practical example. You receive zero point 0.1 Ethereum as a staking reward on a day when Ethereum is worth 5,000 Australian dollars. You have received $500 of ordinary income, assessable in that financial year. Your cost base for that 0.1 Ethereum is $500. If you later sell that Ethereum for $800, your capital gain is $300. Airdrops. The tax treatment of airdrops depends on the circumstances of receipt. If you received tokens because you held a qualifying asset, for example a new project airdrop tokens to all holders of an existing token, the ATO is likely to treat this as ordinary income at the market value on receipt. If you receive tokens entirely unsolicited with no action on your part, the cost base may be treated as zero rather than as income. In this case, the entire proceeds on disposal become a capital gain. If you completed tasks, provided services, or participated in a protocol to receive an airdrop, the ATO may treat this as income for services rendered. The reason for receipt determines the tax treatment. Record the circumstances of every airdrop you receive. DeFi activity creates significant complexity. The general principle is that depositing assets into a liquidity pool constitutes a disposal of those assets, triggering a CGT event on the deposited tokens. You receive LP tokens in exchange, which are new CGT assets with a cost base equal to the value deposited. Trading fees earned from your liquidity position are treated as ordinary income at the time of receipt. When you withdraw from the pool, you dispose of your LP tokens and receive crypto back. This triggers a second CGT event on the LP tokens. Impermanent loss is not separately deductible. The gain or loss is only crystallized when you withdraw, calculated from the LP token cost base. The volume and complexity of DeFi transactions is precisely why comprehensive record-keeping tools are essential. We will demonstrate this practically later on. On budget night, May 12, 2026, Treasurer Chalmers announced that the 50% CGT discount for individuals, trusts, and partnerships will be replaced with a cost-based indexation system, combined with a 30% minimum tax on capital gains, effective from July 1, 2027. Let me break down each component of this announcement precisely. Component 1. Replacing the 50% discount with indexation under the current system. As we covered earlier, you hold an asset for more than 12 months and half your gain is disregarded. Simple, powerful, investor-friendly. Under the new system from July 1, 2027, the 50% discount is gone. Instead, your cost base is adjusted upward for inflation using the Consumer Price Index, the CPI. You then pay tax on your real gain above the inflation adjustment. This is not a new concept in Australian tax. We used this exact system from 1985 to 1999 before the Howard government replaced it with the 50% discount. What Treasurer Chalmers has done is return to the pre-1999 approach. The critical difference for crypto investors is this. Indexation adjusts your cost base for inflation, which for property held over many years can be meaningful. For crypto assets, which can grow at multiples of the inflation rate in a single year, the CPI adjustment provides very limited relief compared to the 50% discount it replaces. Practical illustration. You purchased Bitcoin for 20,000 Australian dollars. You hold it for 4 years and sell for $80,000. Your gain is $60,000. Under the current system with the 50% discount, your taxable gain is $30,000. Under the new indexation system and assuming CPI of approximately 3% per annum over 4 years, your cost base adjusts from $20,000 to approximately $22,500. Your taxable gain is $57,500. At the 30% minimum tax, your tax is $17,250. Under the current system, at a 32% effective rate on $30,000, your tax is $9,600. That is a difference of $7,650 on the same investment. From the same person, because of a change in the calculation method. Component 2. The 30% minimum tax. In addition to the indexation change, a 30% minimum tax on capital gains applies from July 1, 2027. This means regardless of your marginal income tax rate, even if your total income in a given year is modest, you will pay a minimum of 30% on capital gains from that date. This is the component that most media coverage has underreported. It directly neutralizes one of the most effective and commonly used tax planning strategies for Australian investors, timing large disposals to years where your total income is lower, reducing the effective rate applied to your gains. From 1 July 2027, that strategy is significantly less effective. The floor is 30%, regardless of your income. Component 3. Who is and isn't affected? These changes apply to individuals, trusts, and partnerships holding assets outside superannuation. Complying superannuation funds, including self-managed super funds, retain their existing CGT treatment. The 1/3 discount available to super funds in accumulation phase remains in place. The zero tax rate in pension phase remains in place. This distinction has significant implications for investment structure decisions, which we will address in the action plan chapter. Crypto assets are explicitly within scope of these changes. This is not a property-specific measure. Every crypto investor holding assets personally outside super is affected. The transitional rules, critical for current holders. The transitional rules are the most immediately practical aspect of this announcement for investors currently holding crypto. For assets acquired before July 1, 2027 and disposed of after that date, the gain is split. The portion of the gain that accrued up to July 1, 2027 remains eligible for the 50% CGT discount under the old rules. The portion that accrues from July 1, 2027 onwards is subject to the new indexation system and 30% minimum tax. To calculate this split, taxpayers will need to establish the Australian dollar value of their crypto holdings on July 1, 2027. For major cryptocurrencies with active markets, this is straightforward. Exchange prices are publicly recorded. For the date of July 1, 2027 specifically, screenshot your complete portfolio, export your exchange account statements, and record wallet balances. That single day's documentation will be critical for future tax calculations. Assets acquired on or after July 1, 2027 are subject entirely to the new system. No 50% discount. Ever. Indexation only with the 30% minimum tax floor. I want to be clear about the legislative status at the time of this recording. The budget announcement has been made. Draft legislation has not yet been released. The framework is confirmed, but specific implementation details may still be refined. I will update this channel the moment draft legislation is published. Now that we understand both the current rules and the budget changes, let me walk through what this means specifically for different types of crypto activity. For long-term Bitcoin holders, the budget changes are the most impactful. If you have been holding Bitcoin for years with a low cost base and a large unrealized gain, the gap between the current 50% discount treatment and the new indexation treatment is at its widest. Consider an investor who purchased Bitcoin for $5,000 in 2021. As at 1 July 2027, it is worth $70,000. They continue holding and sell in 2030 for $100,000. The gain splits at 1 July 2027. The pre-2027 gain of $65,000 is eligible for the 50% discount. Taxable gain $32,500. The post-2027 gain of $30,000 is subject to indexation. Let us say CPI adjustment of approximately 3% per annum over 3 years. Cost base for this period adjusted accordingly. Taxable gain approximately $27,000. At 30% minimum tax, tax on that portion approximately $8,100. Total taxable position, meaningfully higher than under the fully discounted old system. And this is with the benefit of transitional rules protecting the pre-2027 gain. For Bitcoin purchased after July 2027, the entire gain is under the new regime. For Ethereum holders who are also active in DeFi, the complexity compounds. Not only are the CGT changes relevant, but the frequency of DeFi transactions means the volume of individual events requiring calculation is substantial. Each liquidity pool deposit and withdrawal remains a CGT event. Each staking reward remains ordinary income. And from July 2027, the CGT treatment on disposals changes as outlined. The practical implication is that Ethereum investors with active DeFi positions need to be particularly rigorous about establishing their cost base on every position before July 1, 2027, because the split calculation will require detailed records going back to original acquisition. For altcoin investors, particularly those holding assets that have experienced significant appreciation, the budget changes create an important timing consideration. If you are planning to exit a position anyway and it carries a large gain, the pre-July 2027 window is the last period where the full 50% discount applies to your entire gain. This does not mean you should rush to sell. There are other considerations, including your total income position for the year, the 12-month anniversary of your acquisition, and whether the legislation has been finalized. We address the timing question directly in the next chapter. NFTs are CGT assets, and the budget changes apply to them in the same way as any other asset. If you hold NFTs with unrealized gains and were planning to sell, the same timing considerations apply as for any other crypto asset. The NFT market illiquidity creates an additional practical consideration. Unlike Bitcoin or Ethereum, where you can execute a sale precisely when you choose, NFT disposals depend on finding a buyer. If timing your disposal before July 2027 is a consideration, the illiquidity of specific NFT positions needs to factor into your planning timeline. It is important to note that the budget changes do not alter the income treatment of staking rewards and airdrops. These continue to be assessed as ordinary income at market value on receipt. The change only affects the CGT treatment of eventual disposals. However, the second event on disposal of staking rewards is affected. Staking rewards received before July 2027 that you still hold after that date will have their disposal gain split at July 2027 in the same way as any other asset acquired before that date. This is the question I am asked most frequently since the budget announcement. Should you sell your crypto before July 2027 to lock in the 50% CGT discount? I want to give you a thorough and balanced answer, because this is not a simple yes or no. The case for realizing gains. Before July 2027, the financial argument is clear. For assets with large unrealized gains, particularly those held for more than 12 months, the 50% CGT discount available under current rules is significantly more favorable than the indexation system that replaces it from July 2027. If you were planning to sell in the next 2 to 3 years anyway, accelerating that timeline to before July 2027 locks in the more favorable CGT treatment on your entire gain. The difference on a substantial position can be tens of thousands of dollars. We demonstrated this mathematically earlier in the video. At scale, on a portfolio with multiple assets and large unrealized gains, the aggregate difference can be material. The case against rushing a sale. Before July 2027. There are several important countervailing considerations that must be weighed. First, the legislation has not yet been finalized. Draft legislation has not been released as at the time of this recording. The framework is announced, but details may change. Making irreversible financial decisions based on an unlegislated announcement carries risk. Second, if you are within 12 months of your acquisition date on a significant position, selling before July 2027 may cost you more in lost CGT discount than the budget change cost you on the other side. Always check your 12-month anniversary date before making a disposal decision. Third, your total income position matters. Capital gains are added to your taxable income for the year. Realizing a large gain before July 2027 may push you into a higher marginal rate bracket. The 30% minimum tax from July 2027 may actually be lower than your effective rate if you stack a large gain on top of employment income this year. This requires individual modeling, which is exactly what a qualified tax agent can help you with. Fourth, transaction costs and market timing. Selling and then rebuying introduces transaction costs and exposes you to adverse price movements. If you are a long-term holder who believes in the asset, the tax saving may not justify the execution and reinvestment risk. The balanced conclusion. The timing question is genuinely nuanced, and the right answer depends on your specific position, the size of your gain, your income level, your acquisition dates, and your investment horizon. What I would recommend is this. Identify your largest unrealized gains. Confirm their acquisition dates. Model the tax difference under current versus new rules for your specific income position, and have that conversation with a registered tax agent who understands crypto before making any decisions. What I would caution against is making rushed, unconsidered disposal decisions based on headlines alone. The window before July 2027 gives you over 12 months to make a considered decision. Use that time wisely. Regardless of what you decide about realizing gains, one action is non-negotiable for every crypto investor. On July 1st, 2027, you must record the Australian dollar value of every crypto asset you hold. This is the transitional date that splits your gain under the old and new rules. Without a documented valuation on that date, your future tax calculations will be complicated and potentially disadvantageous. Set a calendar reminder now. On that date, screenshot every exchange account. export account statements, record wallet balances, and save everything securely. Accurate record keeping is not optional. It is a legal requirement. And for crypto investors, given the volume, complexity, and variety of transaction types, it is one of the most practically challenging aspects of compliance. Let me cover the standard the ATO expects and then show you how to meet it efficiently. For every crypto transaction, you are required to record the date of the transaction, the type of transaction, acquisition, disposal, swap, staking reward, airdrop, liquidity pool event, the amount of cryptocurrency involved on both sides of the transaction, the Australian dollar value at the time of the transaction, the exchange, protocol, or wallet involved, all fees paid in connection with the transaction. These records must be retained for a minimum of 5 years from the date you lodge your tax return for the relevant financial year. For assets you still hold, records relating to the acquisition must be kept until 5 years after you lodge the return for the year in which you dispose of the asset. For an active crypto investor with transactions across multiple exchanges, wallets, chains, and DeFi protocols, maintaining these records manually is impractical. The error rate in manual record keeping increases with volume, and the consequences of errors, understated income, incorrect cost bases, missed events, can be significant. This is where dedicated crypto tax software provides genuine value. I use and recommend Coinly, and I want to show you how it works in practice. When you connect Coinly to your exchanges and wallets, it imports your complete transaction history automatically. Every buy, sell, swap, staking reward, and DeFi interaction is pulled in with dates, amounts, and counterparty details. Coinly then applies Australian dollar values to every transaction using historical market price data for the exact date and time of each event. This is the AUD conversion requirement met automatically across thousands of transactions simultaneously. The platform then classifies each transaction type, identifying CGT events, income events, transfers between your own wallets, and calculates your gains, losses, and income for each financial year. The output is an ATO-compliant tax report, showing your capital gains schedule, income summary, and the data your tax agent or My Tax return requires. It maps directly to what needs to go in your return. A few specific features worth highlighting for 2026 and beyond. The cost base tracking accounts for all fees, ensuring your cost base includes acquisition costs that directly reduce your taxable gain. For high-volume traders, this can make a material difference to the final tax position. The 12-month holding period identification flags which assets have been held for more than 12 months, currently qualifying for the 50% discount. This will be critical for the transitional calculations as we approach July 2027. The income tracking module captures staking rewards and airdrop income with Australian dollar values on the date of receipt, meeting the ordinary income reporting requirement automatically. Coinly supports over 700 exchanges, wallets, and DeFi protocols, including all major Australian exchanges and the most commonly used international platforms and blockchain networks. The free plan allows you to import all your data and review your complete gain and loss summary before paying anything. You only pay when you need the downloadable tax report. The affiliate link is in the description. It supports this channel at no cost to you. If you have not yet connected your exchange and wallet data to a dedicated tracking tool, I would strongly encourage you to do so now. The complexity of crypto tax record keeping only increases as your activity grows and the period of time you have been investing lengthens. Starting this process today rather than at tax time gives you a complete, accurate picture of your position. I want to address the most common mistakes Australian crypto investors make and the specific behaviors most likely to trigger ATO attention. Understanding these clearly is the most direct form of audit protection available to you. Mistake 1. Not declaring crypto-to-crypto swaps. This remains the most widespread error. A significant proportion of Australian crypto investors are aware that selling crypto for Australian dollars is a taxable event, but do not realize that swapping one cryptocurrency for another triggers the same CGT event. Every swap is a disposal of the asset you gave up at its Australian dollar market value at the time of the swap. That gain or loss must be calculated and declared. The ATO receives data from exchanges that shows every transaction, including swaps. A pattern of swapping activity without corresponding CGT declarations is a clear discrepancy. Mistake 2. Omitting fees from the cost base. As outlined earlier, fees paid to acquire cryptocurrency are part of your cost base. Exchange fees, brokerage fees, and gas fees all reduce your taxable gain when included correctly. Many investors calculate their gains using only the purchase price, leaving legitimate cost-based reductions on the table and overpaying tax. Mistake 3. Incorrect treatment of staking rewards. Declaring staking rewards as capital gains rather than ordinary income, or not declaring them at all until they are sold, is a common error with potentially significant consequences. Staking rewards are ordinary income at market value on receipt. They must be declared in the financial year they are received. Deferring this declaration to the year of sale is incorrect. Mistake 4. treating wallet transfers as taxable events. The opposite error also occurs. Some investors declare transfers between their own wallets as disposals, generating unnecessary CGT events. Moving cryptocurrency from one wallet you own to another wallet you own, with no change in beneficial ownership, is not a taxable event. It is important to correctly label these as transfers in your records. Mistake 5. Wash sale arrangements. The ATO has specifically identified wash sales, selling an asset at a loss and immediately rebuying it to crystallize the loss while maintaining the economic position, as a focus area. Arrangements that are entered into primarily to obtain a tax benefit without genuine economic substance can be challenged by the ATO under general anti-avoidance provisions. Capital losses generated through genuine disposals are entirely legitimate. Manufactured losses through artificial arrangements are not. Mistake 6. Not lodging at all. The ATO's data matching program receives transaction data directly from Australian exchanges and through international data sharing arrangements under the Common Reporting Standard. If you have had exchange activity and have not lodged a tax return declaring that activity, the ATO likely has information that contradicts your lodgement position. The mismatch between exchange data and lodged returns is the primary trigger for review and audit. If you have unreported crypto activity from prior years, voluntary disclosure before the ATO contacts you is the most effective protection. Penalties are significantly more lenient for voluntary disclosure than for cases the ATO identifies through audit. Engage a qualified tax agent immediately and do not wait for ATO contact. What the ATO is actually looking for. The ATO's data matching process is automated and operates at scale. It identifies anomalies, discrepancies between the exchange data the ATO holds and the declarations made in tax returns. The system does not primarily target individuals. It targets patterns of non-compliance. The investors who attract audit attention are those whose declared position is inconsistent with the data the ATO holds about them. Accurate, complete, and timely lodgement is the most effective protection. There is no substitute for it. We have covered a substantial amount of ground in this masterclass. I want to close with a clear, prioritized action plan. Specific steps you can take immediately to protect your position and manage your obligations for the 2026 financial year and beyond. Action 1. Get your records in order. Now, if you have not connected your exchange accounts and wallets to a dedicated crypto tax tool, do this today. The longer you leave it, the more historical data you need to reconstruct. Coinly allows you to import historical transaction data and will generate a complete picture of your position, including unrealized gains, cost bases, and 12-month holding periods. The affiliate link is in the description. The free plan shows you everything. You only pay when you need the report. Action 2. Identify your largest unrealized gains and their acquisition dates. With your records in order, identify your positions with the largest unrealized gains. Note the acquisition date of each. This tells you which assets are currently eligible for the 50% CGT discount and which are approaching their 12-month threshold. This is the foundation of any timing strategy discussion. Action 3. Engage a qualified tax agent before October 31st, 2026. If your crypto activity has any meaningful complexity, multiple exchanges, DeFi involvement, staking activity, or significant unrealized gains, engage a registered tax agent who understands cryptocurrency before the October 31st self-lodgement deadline. Registering with a tax agent before October 31st gives you access to the extended May 15, 2027 lodgement deadline. More importantly, it gives you access to professional advice on the timing strategy question and the 2026 budget changes before you make any significant decisions. Action 4. Have the timing conversation with your tax agent. Armed with your records from Coinly and your acquisition date analysis, have a specific conversation with your tax agent about whether realizing any gains before July 2027 makes sense for your individual position. This conversation needs to account for your current income level, your marginal tax rate, the size of your positions, whether you have 12 months of holding on each asset, and your investment intentions. This is not a decision to make based on general advice from a YouTube video. It requires individual modeling, but you are now equipped to have that conversation with the specific knowledge and context it requires. Action 5. Set your July 2027 calendar reminder. Regardless of any other decisions you make, set a calendar reminder for 1st July 2027 to record the Australian dollar value of every crypto asset you hold. Export exchange account statements. Screenshot portfolio balances, record wallet values, save everything securely with multiple backups. This is the most important single date-specific action item in this entire video. Do not miss it. Action 6. Stay informed as legislation develops. The budget announcement has been made, but draft legislation has not yet been released. Subscribe to this channel and turn on notifications. I will cover every development as it occurs. The implementation details matter and they will become clearer over the coming months. Action 7. If you are behind, act now. If you have unreported crypto activity from prior years, do not continue to wait. Every additional day of delay increases the penalty and interest exposure if the ATO identifies the non-compliance before you come forward. Engage a tax agent immediately. Pull together your historical transaction data using Coinly and initiate voluntary disclosure. The earlier you act, the better the outcome available to you. We have covered every major aspect of the Australian crypto tax landscape in this masterclass, from the foundational CGT treatment of crypto assets through the income treatment of staking and DeFi activity to the most significant tax law change in a generation and its specific implications for every type of crypto investor in Australia. The theme running through everything we have covered is the same. Informed investors who understand the rules, maintain accurate records, lodge correctly and on time, and take professional advice where needed, are in the strongest possible position regardless of what the tax environment looks like. The 2026 budget changes are significant. They are not a reason for panic. They are a reason for informed, deliberate action, and you now have the knowledge to take that action from a position of genuine understanding. If this masterclass delivered value to you, please subscribe to this channel and turn on notifications. I publish regular, detailed, and accurate content on every aspect of Australian crypto tax. This community deserves reliable, professional information, and that is what this channel exists to provide. If you found this video useful, please share it with any Australian crypto investor in your network who needs this information. The changes ahead affect every single person holding cryptocurrency in this country. Drop a comment below with any questions, or let me know which chapter was most valuable to you. I read and respond to every comment. The link to Coinly is in the description. The affiliate link supports this channel at no cost to you, and I genuinely recommend it as the most effective tool available to Australian crypto investors for managing their tax obligations. This is general information only and does not constitute personalized tax advice. Please consult a qualified accountant or tax professional for your individual circumstances. Thank you for watching. Stay informed. Stay compliant. Stay cashed up.